There's something brewing behind the scenes that could mean big pain for stocks through the back half of 2023. The year-to-date gains on the three major indexes are pretty respectable. Dow's up about 6%, S&P's up about 16%, and then the NASDAQ 100 is up almost 40% on a year-to-date basis. So needless to say, most people over the last 7 to 8 months have probably had a really good time in the market unless you've been shorting the market. But there's one thing brewing underneath the surface in the market that could spell big pain for stocks in the back half of 2023 and the beginning of 2024. We're going to talk about all that in this video and how to position yourself to take advantage of this and how to minimize your downside. But first, before we get into all that, thank you for being here. I'm Austin. I'm a co-owner at cloudmusicsuite.com and I'm a stock market investor. Channel's somewhere in the 1,700 subscriber range. If you're not one of those people and you haven't subscribed yet, go ahead and click that button for me and drop a like. If you're back, thank you so much for being back. As a thank you for subscribing, here is a picture of both my cats, Millie and Luna. Millie's the gray one, Luna's the brown one. They thank you for subscribing. Okay, stocks have had an amazing year so far. On a 1 year basis, the returns look a lot less impressive, but on a year-to-date basis, all the indexes are up very nicely. So I would bet most people that are watching this video have made some nice gains, at least on a year-to-date basis. Maybe not on a 1 year basis because of all the pain we had in 2022 and the back half of 2021. But is this bull market that we seem to have entered going to continue, or is this just a little bit of a rise before we see a much bigger deceleration? Let's talk about it. So the big reason we had a lot of pain in 2022 was because of the rate hikes. Obviously, inflation went out of control, ridiculous. The Fed was saying that inflation was transitory, meaning it's not here to stay. We realized very quickly that it was here to stay, and pretty much all investors realized it was here to stay way before the Fed did. So all the hopium and risk on in the markets started to get smacked down by those inflation numbers, and then it really got smacked down by the Fed raising rates the fastest they have in a very long time, to levels that we haven't seen in over 20 years. Almost all investors in the market right now are used to very low rates, something close to a 0 rate on the Fed funds rate. That is not sustainable on a long-term basis, and this 5% rate, although it seems high, is really not all that ridiculous historically. But it seems like so far, all these Fed hikes have not done all that much. Remember, the Fed's target is a 2% inflation rate on an annual basis, which means most months have to be a 0.2 month-over-month increase, and some have to be a 0.1 month-over-month increase. The current expectation is that we're going to be at 0.2 or 0.3 on a month-over-month basis for all months throughout the rest of 2023. That's going to keep us well above that 2% inflation rate, which definitely means the Fed is going to keep rates where they are and potentially raise rates even more if we see an acceleration of inflation. So in May of this year, 2023, we had a forward rate. This is a bond market measure of inflation pricing. That forward rate was below 4% in May. Now, just a few months later in August, we've got that forward rate at 4.83%. So now the expectation is that inflation is going to accelerate in the back half of 2023. If we see inflation accelerating, which we already saw, by the way, we had a 3.0 print in June, we had a 3.2 print in July on the CPI. If we see anything above a 3.2 print in August, definitely for sure expect that the Fed is going to raise rates at least one more time. They've already signaled that they're going to raise rates one more time, so we should expect it anyway. But if we see an acceleration in inflation, they're definitely going to go ahead and raise rates. And the commentary from Jerome Powell is not going to be positive. He's going to seem hawkish. He's going to want to raise rates even more. And we're just going to keep on pushing that Fed funds rate higher if inflation keeps on going out of control. There's only a few things that the Fed has at its disposal. One is QT, quantitative tightening, and two, raising those Fed funds rate to put more pressure on the economy, to cool down the economy a little bit. As it relates to the macroeconomic environment, it seems like the rates haven't done all that much yet, but that pain is probably going to start playing out in the back half of 2023. That's why I think stocks could see a lot of big pain in the back half of 2023. The general consensus from analysts on small and mid-sized businesses is that we've got a big pipeline of growing delinquencies, which means people are not going to be able to service their debt as these rates stay elevated and rates stay at these high numbers. So now the current projection is that basically the economy is going to get a lot worse and the market's going to get a lot worse before it gets better. The stock market and the economy are not the same thing, but earnings are what moves stocks in the long term. So if earnings are lower because spending is lower and consumer discretion is lower and government spending is lower because we're doing QT, then we're going to see medium-term pain in stocks. A year of weak earnings is a year of weak returns. A year of great earnings is a year of great returns. And the more amount of money companies have to spend on servicing debt and the less amount of money they're bringing in because the consumer's in a weak spot, the worse earnings are going to be, obviously. Sometimes the headline numbers can look okay because a lot of these companies put a ton of their money into treasury bills, and those treasury bills are yielding pretty high rates right now because the Fed funds rate is so high. So they're getting a lot of interest income, but we need to look at income from operations. We need to focus on income from operations when we look at the income statements of these companies that we're trying to own. So if all these expectations are correct and we get somewhere around a 4.8% annual inflation rate throughout full year 2023, we should definitely expect the Fed to not slow down their rates hiking cycle, and they're going to probably raise rates a couple more times in 2023, maybe even into 2024. And then once they've got inflation really close to 2% or at 2%, I would bet they're going to hold rates steady for quite a while before we see that first cut, which means any company that has a somewhat weak balance sheet is going to see a lot of pain. The market's going to throw that company in the trash. Why? Because they have to do one of two things if they don't have enough cash to fund their operations. If they're not EPS positive already, that means they definitely don't have income from operations, which means they can't fund growth of the business from operations. That's a red flag right there. So that means they have to either issue more shares, which dilutes shareholders and decreases total return, or they have to take out debt. And guess what? They're taking out debt at these extremely elevated rates, which puts the balance sheet in an even worse spot over the medium term and over the long term. I can tell you right now, as someone who has messed up and owned a company that has a bad balance sheet, it's not a good time, especially in high rate environment times. I got burnt for sure. I learned my lesson, and I will not be buying weak balance sheet companies ever again, especially not in a risk off time like we're in right now. So focusing on quality companies that have free cash flow, that have positive EPS, and have a very strong balance sheet is more important than ever. If you've watched my channel before, you'll know that I own some high beta stocks. I own Palantir shares. I own SoFi shares. I own Shopify shares. I own Tesla shares. These are very high beta companies. They move more than the market. But stocks I don't talk about as much because they're not as exciting and people don't want to hear about them are companies like Waste Management. These are companies like Lockheed Martin, companies like AllianceBernstein Holdings, 3 beastly dividend payers, 3 value stocks that I have very, very heavy positions with. Those are all in my top 7 holdings. And on most days that my high beta stocks are red, those 3 value stocks specifically are green. I have other companies that are value related, and I have other companies that are dividend related, like 3M, like Stag Industrial, which is a freaking warehouse REIT company, super boring, super stable. But if I didn't have those, my returns would be much less stabilized, and the painful days in the market would be way more painful, and I wouldn't be getting that dividend money on a regular basis. Have those companies I just mentioned been flying higher over the last few months that we've kind of entered this little bull market? No, but they also didn't see nearly as much pain whenever we had the market depression with countless stocks dropping 30, 40, 50, 60%. Those stocks definitely did not drop 30, 40, 50%. Lockheed Martin was positive over that time. Waste Management was positive over that time. Stag Industrial was positive over that time. So my main advice here is maybe don't focus all on spec stocks. Maybe don't focus all on high beta stocks. And if you are going to focus on some of those companies, please just make sure they're free cash flow positive, and please make sure they have a strong balance sheet. And if they don't have a strong balance sheet, they're not cash flow positive, keep it as a spec play. Keep it as a small percentage of your portfolio. And consider looking into some of those value stocks. Consider looking into some of those dividend stocks. Find the companies that you think are going to do well, that fall into those value categories, that fall into those dividend categories in the stock market. I can tell you from my own experience with my own portfolios, it helps me sleep better at night if I have some of those boring companies that I feel really, really, really confident about, that are super stable, nice growing business models, pretty dang inflation proof, and pretty dang recession proof. What is more recession proof than Waste Management? Past that, I'm personally not buying that many stocks right now. My total purchases and my total purchase amounts of shares have decreased substantially over the last 2 to 3 months as we've seen this continued strength in the market. I was a really, really heavy buyer at the end of 2022. I was a really heavy buyer at the beginning of 2023. My buys have dropped off a cliff. I'm still buying some stocks right now, but my total buy orders I'm putting in are way lower. So I'm building up a nice cash pile so that I'm ready for any potential dip. I don't want to stay 100% in cash. I'm not even close to that, but somewhere around 10 to 20% cash. I don't know the exact percentage right now, but I want to make sure I'm ready in case we have any big downside in the market. There are some stocks I would love to own. There's some value stocks I'd love to own. There's some growth stocks I'd love to own. There's some dividend stocks I'd love to own that I just don't love the pricing on right now because I see some potential downside in that share price. So I'm staying focused on all the different types of stocks in the stock market. I've got some turnaround plays, I got some value plays, I got some dividend plays, and of course I got some growth plays with a nice cash position ready to scoop up shares of the companies I want to own for the long term. If we see any pain, I know I'm gonna be ready. I wanna know how you're prepping yourself out there. Are you hedging in any type of way? Do you have any short positions in the market in general? Do you have any short positions on specific stocks? What's your specific strategy as we move into the back half of 2023, given the fact that we now have inflation projected to be around 4.8% for the full year, rather than that 4% number that we saw somewhere around May of this year? I want to hear about it. Let me know in the comments. Get down there. That's one of my favorite parts of posting here on YouTube, is seeing those comments. I appreciate you being here, and have a great day.